bill or tax burden. It was just to fairly equitably share and spread that tax burden across all property owners, so that in proportion to the value of their property, they were paying their fair share. So that McMansion wasn't paying the same as a mobile home, but there was a difference in the value of the properties, so there should be a difference in the amount that they pay. And that's the purpose of the appraisal districts. And then you have the tax office, and they actually calculate the tax bills, they'll mail them out. What happens with the taxing units in the tax office, they come after the appraisals go out. We do our appraisals in April, we do our protest, we certify the roll to the taxing entities in July, then they start calculating their budgets, their tax rates in August, and then tax bills will ultimately go out in October and November. So we are kind of, in a continuum, we are the first step in the process of the property tax system, but we are by no means the final or the only step in the process. So your tax calendar and really important dates to understand, January 1st is the assessment date for appraisals. So we're appraising properties as of January 1st. Whatever their state, if they were partially complete, January 1st is our assessment date. If they burn down later in the year, January 1 is still our assessment date. If it was in place on January 1, it's still taxable for that year. So January 1 is the key date that triggers a lot of the actions from the appraisal districts. Starting about April 1st, notices of appraised value start getting sent out. We sent ours out mid-April this year. It just took us a little bit longer to do all of our processing, but they start sending out in April 1st. May 15th, or 30 days after you get your notice of appraised value, is your deadline to file your protest. July 25th is the date that we have to send certification information to the taxing entities so that they can start their calculations. And then in August and September, the tax rates are set. October, the tax bills begin being mailed. And then in November, if there is a tax rate that goes above the voter approval rate, that is a mandatory election now that happens the first Tuesday in November. So that's a November election for voter approval elections. And then January 31st is when tax bills are due from your property tax bills. So there are three factors that are going to impact the amount of taxes anybody will pay. One is going to be the appraised value established by the appraisal district. The second is going to be any exemptions, if they are qualified for any exemptions, and the amount of the exemptions that they're qualified for. And then third would be the tax rates that are set by the taxing entities. So again, the appraisal district, we're just to spread that burden across all property owners through our appraisals, but exemptions and tax rates also play a really big role in how much somebody's ultimate tax bill is. Notices have gone out. We just want to tell everybody, don't panic. Don't panic, not yet. We send our notices of appraised value out, and that goes out first, and there's been significant increases across the board that property owners have seen. But there are a lot of protections in place for property owners. There are protections in place for property owners that have a homestead exemption. You've got a limitation, you've got the exemption amount that you've got protections on. And then there's also protections for the property owners on the rate side. And it's new, property owners probably aren't very aware of it, but there's a levy limit now on the taxing entity side. So your cities and counties, they can't increase their total levy more than 3.5% unless they go out for voter approval. So voters have the right to say in November whether or not they're going to adopt a rate that's going to be higher than a 3.5% increase, which is a lot less than it used to be. So there are some really important protections on property owners. Just because your appraised value went up does not mean that all equates to a tax increase. Again, there's limitations on increases in your assessed value, but there's also new limitations on the levy. And that is something that is, again, it's only 2 years old, it's only been in place for 2 years, and property owners haven't really noticed it. You'll notice it this year, that there's that limitation in the levy as well. And that's key for you guys. It's really important to understand that and to participate in those elections when they come up. If your entities are going above a voter approval election, it's really important that you participate in those. We've got a website, travistaxes.com, that can help you see that breakdown, but that again doesn't get uploaded or updated until the taxing entities start setting their rates, and that happens in August and September. So this part of the season is focused primarily on appraisal districts, but it's important for property owners to participate in August and September. And I can tell you, I get 150, 140,000 people that will protest and come to my door. taxing units will see 2 to 3 people show up for a budget hearing or a tax rate hearing. Not enough people participate in that other side of the equation.
So that's like a city council meeting?
City council meetings.
So they're the ones that are directly
Yes.
going to this room?
Yeah, yes. Yeah, and again, we get a lot of participation on our side because we send you individually a notice of appraised value. You don't get that same kind of invitation from the city or the county for when they're setting their tax rates. But you can now get that information on travistaxes.com. And again, more this year than any other year, it's really important for property owners to participate on both sides of the equation. So market values, how do we determine our market value? Well, the market value is based on what your property would sell for on January 1st. That's our assessment date. That's our requirement, is to appraise the properties as of January 1st based on what a willing buyer and a willing seller would transfer the property for. So we're looking at market data from the previous year. We get tested to make sure that we are appraising properties at 100% of market value. We are tested by the comptroller's office. They test us every year. And for the last 2 years, they have indicated that we have been invalid in our Western Travis County school districts, meaning that they have found that we are too low in our values. And if we are too low for more than 2 years, it starts impacting school funding and school finance. So we have a real urgency to make sure that we pass the property value study this year, because we don't want our school districts to be negatively impacted and get less state funding than they are entitled to, because the comptroller deems that our values are too low. So we again have put a really keen focus on ensuring that our market values are as close to market value based on the data that we have. Now, we don't have all of the data, and we get tested. The comptroller has more data than we have, and they have data from sources that we don't have access to, but they still test us on that data. So, you know, we have to do the best that we can with the data that we do have to make sure that we are meeting our burden to appraise properties at 100% of market value. The assessed value, this is the reduced value of your property based on any limitation that you may have because of a homestead exemption. So when we're making a market value determination, we'll determine market value. There is no limit on market value. It is whatever the market tells us it is. Whatever the data says it is, that's what market value is going to be set at. Assessed value has a limitation, and it's a state mandated limitation on the increase of the assessed value. The assessed value is calculated as last year's assessed value plus 10%, or the current market value, whichever is less. Now, you guys tell me when the last time you saw the current market value go down in Austin. So for most of our property owners, it's last year's assessed value plus 10%. And again, that's a state mandated calculation. Your assessed value gets established the first time you qualify for your homestead exemption. That sets your base assessed value, and the calculation happens the year after that. So your assessed value gets established the first year that you qualify for your exemption on January 1st, and then it's calculated as 10% above that number each year. Assessed value, again, is the only calculation that we have that is based on last year's data, because it's last year's assessed plus 10%. Market value is based on whatever the market says today. So last year's market value has no impact on this year's market value. It's about what does the market data tell us today. Assessed value is based on that limitation. And then finally, you have your taxable value, which is your assessed value minus the value of any exemptions that you may be entitled to. That becomes your taxable value. And then your taxable value times the tax rate equals the amount of taxes that you pay. So those are the 3 key terms that we've got when we're talking about values at the appraisal district. Market value is the one that is determined by the appraisal district. The assessed value and the taxable values are just calculations. So when you protest, if you protest, what you're protesting to the appraisal district is our determination of market value. So determining market value, again, the state law requires us to appraise all property at 100% of market value, what it would sell for. Our assessment date is January 1st of each year, and we use sales of similar homes to determine the market value. We collect data over the course of the year, and then we use models. Now, we don't do fee appraisals because there's 470,000 properties in Travis County. We can't do 470,000 fee appraisals every year with our staff and our budget. So we do mass appraisal models, but we'll use the data and look at it in terms of market areas, neighborhoods, and calculate what the adjustments should be in any given neighborhood to fairly represent the market value in that area. We'll use characteristics of the property when we're determining it. We're going to look at the size and the type of improvement. We do measure from the outside So if you've got plans, and the plans are giving you a certain square footage and our square footage seems to be off, please note that we're measuring from the exterior, because we've got to treat all properties the same, and we can measure all properties from the outside. We don't get the right of interior inspection, so we can't get on the inside to do interior measurements. So all appraisal district measurements are done from the outside, but we'll look at the size, the type of improvement. Is it a single family? Is it a duplex? Is it a townhome? Is it a condo? And we'll group similar single family with single family, and when we do our comparison. We'll look at construction materials, quality and condition, and then we'll look at site characteristics. Is there additional lot land? Is there a swimming pool? Or are there any additional items that would add value to the property? All the information about your property and property characteristics are available on our website. So you can go to our property search, pull up your property, and you can get all the information that we have about what we've determined were the key characteristics for your property for the purposes of our appraisals.
Real quick question. So would you say that that's one of the reasons why sometimes you see a builder's square footage be different than what the tax is saying? And
Yes.
In which case, we would probably want to go with the builder rather than y'all.
Yeah, we have to measure all properties the same, so we measure from the exterior.
Right.
So our records can be off 4 to 5%, because the width of that brick, when you do an exterior measurement, can increase the square footage. One of the things that you may want to look at, and when you look at our square footage, if it seems to be off more than that, again, we don't have the right of interior inspection. Sometimes there are areas of the home that look like it's 2 stories, but it may only be 1 story, 2 stories high. And we can't see that necessarily from the exterior. And that might be something that you might be able to point out to us that would change our square footage. And if there are, if there's just attic space, but it's unfinished, those kind of things that can change our square footage. So look at the characteristics that we've got, but one of the key things that we see most often that causes discrepancy is either the difference between interior and exterior measurements, and then the identification of those areas of the home that may be 1 story but 2 stories high, that we can't tell that it's not actually 2 levels.
Do you deduct for garage? Because I don't think there's that big of a discrepancy, really.
Garage is a separate item on our record, so you'll see a line item that lists garage.
That's right.
Yes, we list that out separately from the main interior living space.
Okay.
And again, assessed value is the reduced value for your property based on any exemption, homestead, and limitations. So the notices of appraised value, what you'll see on the very top of it, we've got market value, and then right next to it, we put the assessed value. So if you don't have a homestead exemption and you don't have the limitation, those 2 numbers will be the same. But if you have a homestead and you have that protection of that limitation, you'll see that your assessed value is going to be substantially lower than your homestead value. And for us in Travis County, this is a really typical example of what we're seeing in terms of the difference between assessed value and the limitation value. It's almost a 50% differential for most property owners. So there is a huge difference on the notice of appraised value between market value and assessed value. But again, the assessed value only comes into play if you have a homestead exemption. And the assessed value gets established the first January 1st that you own the property is your base year, and that calculation kicks in every year thereafter. So brand new homeowners or people that just purchased their property aren't going to see the benefit of the limitation. But I will say, even though they don't see the benefit of the limitation and they have a homestead, what they will still see is they will still see the benefit of the exemption amount. And that can be huge, because the city of Austin finally went up to a 20% homestead exemption. You get 20% from your from the county as well. The healthcare district does 20%, and the school districts do $25,000 as a flat amount. But there's an election coming up next week that will increase that to $40,000. So there's still benefits from the homestead exemption, even if you may not be qualifying for the limitation just yet as a new property owner. So we encourage them, if you qualify for exemption, file your exemption application, because we don't want you to miss out on your 20% exemption.
Can I ask you a question on that?
Yeah.
So for this particular home right here, so it's a resale, so new owner buys the property and it's going to be their primary. I know that y'all made the change that allows people to put their homestead exemption essentially right when they buy it and not having to own the property January 1st. So next year in 2023, are they going to see their assessed value basically meet market value, or is that like a trick to keep those
So
the assessed value low.
And I think we've got some slides on that.
Okay.
We have slides on that prorated. We've got some slides on that one, and
Perfect.
I'll go that in a little bit more depth because there are some conditions
Mhm.
to qualifying for that exemption a little bit earlier, and there is also some conditions for when do you start calculating that assessed value
Yep.
on those. So yeah, I think we'll go into that,
Perfect,
and I
thanks.
think that might be coming up pretty quick. So again, this is just another example of the assessed value. If the home is purchased in March of 2020, then their first January 1st was 2021, that set their base year. And then January 1st of 2022 is the first year that you'll see the 10% limitation calculation. So that's just an example of just a regular homeowner that has purchased their home and they have the benefit of the limitation. Generally, you're eligible for a homestead exemption if you own and occupy the property on January 1st. Generally, but there's new law that allows you to qualify for that earlier. But we want to stress for property owners that it is free to file your application for your homestead. New owners will get a lot of things in the mail and got lots of offers of people, pay me $50, $100, I'll file your application for you. And we don't want them to pay for something that they can get for free. It's free to file the application with the appraisal district. You can do it on paper, you can do it online, but it doesn't cost you a thing to file that. The exemptions take an amount from your taxable value. Again, City of Austin is a 20%. And there's a variety of exemptions. You've got your homestead, you've got your over 65, there's disabled veterans. Again, most of the exemptions, if you're going to get an exemption, you've got to file an application for it. The general deadline for filing an application is April 30th, but property owners can file late applications up to 2 years late. So in a general homestead exemption, you can file it, so it's not too late for any property owners that may have missed out and just now realize that there are some benefits. You can file your application up to 2 years late and we will still apply it and we'll go back and make it retroactive and you make it a refund.
Nice.
But it will make it retroactive for the calculation of your 10% cap. So it's important, even if it's late, to still file your application for your exemption. Again, we've got a general homestead, over 65, disabled person, disabled veterans. If you're a surviving spouse, you can get an exemption. The solar and wind exemptions, it's kind of a wash. We don't typically pick those up unless we get an exemption application, in which case we've got to pick it up just to take it right back off. So it's kind of a wash if you file for solar or wind. And then if there was a disaster, any disaster related exemptions might be approved.
Surviving spouses, if the spouse who died had the over 65 in his name and the surviving spouse wasn't 65, do they get to keep that 65?
As long as they are age 55 or older, they get to keep the over 65 exemption amount, and for the school district, they get to keep the ceiling, the tax ceiling.
And does it matter if they take that deceased spouse off the deed?
As long as we know that they are a surviving spouse, and there's specific places in the exemption application that they can notify us that we're a surviving spouse, that yes, they can keep the exemption.
And so it stays frozen at what they're...
It stays frozen at what when the original spouse qualified for the exemption. And again, in order to be a surviving spouse, you have to be age 55 or older to be a surviving spouse. Now, I will say for the over 65, one of the biggest things that we see that creates problems for new property owners is they purchase a property from somebody that is over 65 and it has that tax exemption and the ceiling in place, and they close and you do everything to prorate the taxes, and then 2-3 months down the road, that original over 65 owner decides that they want to port or transfer their over 65 exemption to their new home, which they can't do by law. But that means that this owner over here who closed and prorated your escrow taxes based on a low amount now suddenly has an increased tax burden. And that's because the over 65 owner took that exemption and moved it to a new property. We can't stop them from doing it. They're allowed to do that by law, but it is something, at closing to make sure that if it's a property owner with an over 65, make sure that they commit to the new owners that they're not going to move that exemption out from underneath them, because it makes a difference. In terms of the overall tax liability, it's one of the biggest things we see that catches new property owners.
And if they don't move it, like take steps with the new county or wherever they are, that over 65 will stay in place the rest of the year.
Generally, the exemptions stay in place for the remainder of the year, and then the new owner qualifies the next January 1. So both the general homestead exemption and the over 65, as long as they don't move it, stays with that property for the remainder of the year.
Okay. Is there any case that it wouldn't?
The only time that it would not stay with the property for the remainder of the year is if the over 65 owner chooses to move it to another location.
Okay.
And the only exemption that they can move is the over 65 or disabled person. The homestead, general homestead, stays in place, but they can move the over 65. And because that's got the tax ceiling, and that's school taxes, that can be huge. That can create a huge liability.
Just curious on the homestead, if somebody were to close, like say this week,
Mhm.
on a home, would there be any benefit to them just writing out the existing homestead exemption and then filing as of January 1st? Is there any benefit to waiting or going ahead and filing now?
There is, if the exemption is already in place
Uh-huh.
on the property and you are a brand new owner, you cannot claim your new exemption
Because you don't
early.
live there as of January.
You cannot claim it early if the property already has an exemption in place.
Okay, so
So-
it'll just stay on there for the rest of the year?
It'll stay on there for the remainder of the year. Now, I will say this, for a new property owner, it's a huge benefit to them because not only do they get that exemption amount, but they get the benefit of that cap or limitation for the remainder of the year.
Mhm.
So it is a huge benefit for them to let it ride this year.
But then January 1 would fall off, so you guys would be able to catch up, and then they have to refile.
Mhm.
So then they start their cap at a new ceiling,
Well,
new base.
they're going to start their cap at a new ceiling anyways, just because of how the prorated, and it's called a prorated exemption when they can file early, that prorated exemption. And we call it a prorated exemption because when you file early, you don't get the full benefit of the exemption amount. You get the exemption amount prorated based on the number of days of the year that you've owned the property. So if you've only owned the property 50% of the year, you're gonna get 50% of the exemption amount. Whereas if you inherit the exemption from the previous owner, you get 100% of the exemption amount and you get the benefit of any cap limitation that that previous owner may have had.
So we need to counsel our buyers not to
File
put it-
early.
to not file early.
Yeah, if they file early and it already has an exemption in place, we can't grant the exemption for them. So even if they do file early, we can't grant that
It
exemption
stays,
for them.
it still's gonna ride.
They still ride
Okay.
with the previous owner's exemption.
So only if the house doesn't have an exemption, new construction or an investment property that they buy that doesn't have anything on it, then you want to file it.
Then you want to.
Otherwise, you just wait till January and do it then.
Exactly. So here's the new exemption. So for 2022, brand new, if the property does not have an exemption on it as of January 1st, meaning the previous owner hasn't claimed the exemption, you can file for it early. Again, you're not able to do it if you claim an exemption on another property because any property owner can only have one. So it can't have an exemption already on it, and you can't be claiming an exemption on another property. But if you meet all the other requirements of an exemption, of the homestead exemption, you could qualify for it. Again, it's prorated based on your qualification date, and that's the date that you move in. Now, the question we get a lot on new construction is people will enter into contracts for new construction, and I'll close on my new construction, say maybe in February, but it's not done, and I don't get to move in until August. Well, your qualification date is based on the date that you own and occupy the property. So your qualification is going to be based on the August date of when you actually move in, not when you initially closed on your property. So that's important for new homeowners to understand in new construction. And again, that exemption is prorated based on how many days remaining in the year divided by the total number of days in the year. So this just is just an example of a property that claims the new exemption. And they started claiming it April 1st of 2022. There's 275 days left in the year out of 365. It's about 75%. So a school district homestead exemption at $25,000 times 75%, they would get $18,836 in exemption amount taken off of their assessed value to calculate their taxable value. So again, the new qualification exemption is prorated, and it's important for people to understand that it is a prorated exemption. It's not the full amount. To qualify, you just have to complete the exemption application. Let me go back to this one more time so I can talk to you guys a little bit more about calculating the cap when it's a new property that has qualified in this example. So say, for example, somebody, new construction, they occupy the house starting April 1st of 2022. The homestead exemption, they can qualify and get the exemption amount for 2022. The prorated exemption amount for 2022. But their homestead cap, their base year does not get set until the first January 1st that they own the property and qualify for the exemption. So they don't set their base year until January 1st of 2023. Their first year that they will see the 10% calculation will be January 1st of 2024. So there is a longer delay for when you get to see the kick in of that homestead limitation, because that homestead limitation is still based on a January 1 assessment date and a qualification date of January 1. So if you qualify for the exemption early, and we still encourage you, if you don't have an exemption on the property, fill your exemption out because you get that 20%, but your limitation does not kick in until after the first January 1st that you own and qualify for the exemption. And then the calculation is your base year is the first year, that first January 1st, and then the calculation happens every year thereafter. And it's a little bit complicated, but you know, that's the way the law was written. But we just wanted to make sure that we explain. Any questions on that one? Because I know it can be confusing. Yes?
They close April 1st, they don't get it on until June the 1st. Does it 20% from April 1st or from when they file it?
So if it's the date that they qualify for the exemption. So you can file a late application.
Yes.
And you can be late, but if your qualification date was April 1st, then it's going to be whatever from April 1st, whatever prorated amount from April 1st.
So the people that I forgot to tell.
Yes. There is a place for, on the homestead application, there's a place for you to put in your move-in date.
Okay.
And they just need to fill out that move-in date. That move-in date becomes their qualification date.
And so you were talking about that cap starting that January 1st. Is this, we're still talking about new construction, or is this on resale?
This is on anybody that would claim the new exemption. The first January 1st for everybody, the first January 1st that you qualify for the homestead exemption is your base year.
Yeah.
That's everybody. Now, if you qualify for it early, you still have to wait for that January 1st to meet your first year. And then your 10% calculation is after that.
So if that cap was there for the previous owner who had homestead, right? And the market value is double what that cap is, come January 1st, when the new owner is going to put their exemption on there, it's going to reset to the assessed value to match the market value.
Yes,
Okay.
yes. You do not get to inherit the previous owner's exemption forever. You can inherit it for the remainder of the year, but January 1st, everything gets reset and you start qualifying on your own.
Yeah, so we should all counsel our clients on the fact that it's going to be your tax rate times market value, you know, minus a little bit on the exemption, regardless of if it's a resale that's got low taxes compared to the market value right now.
You are always safest if you base it off of your sales price times the tax rate. That's going to be your safest bet in terms of just trying to predict what the taxes are going to be. The other thing that we see often in new home construction is they'll look at last year's taxes. But you know, last year on January 1st, it was just vacant land, and that's all we've got on the roll is vacant land. The next year, you've got the whole house on it, and their value goes way up, and they're like, well, wait, my taxes last year were only this amount, and that's because last year it was just for vacant land, and so that's another thing that catches people unaware. New homeowners get caught off guard by that. So to apply for an exemption, they just have to complete the application. Include a copy of all required documents and submit the application to the appraisal district. Again, the general deadline is April 30th, but you can file up to 2 years late. There is no fee. It's free to do it with the appraisal district. We've got an online portal. You can do it online. The required documents, we find that oftentimes, we find that 57% of property owners forget to include the required documents. And the required document is a copy of your driver's license or your Texas state ID. And it's got to be a Texas driver's license or a Texas state ID. We can't take a concealed handgun, we can't take a military ID, we can't take a passport. It's got to be one of those two pieces of information, and the address on that ID has to match the address of the property that you're filing for, the exemption for. So sometimes there's a delay for property owners because they're waiting to get through to DMV so that they can get their driver's license updated. Yeah.
Can the mailing address be different, or does it have to be the same?
Mailing address has to be the same.
Oh, it has to be the same?
Has to be the same. Yeah, it's a state law requirement that the mailing address on the address on the ID has to be the same.
Oh, no, the address on the ID, yes, but I'm talking about like whenever you're filling it out.
Oh, whenever you're filling it out, if you want it to go to your P.O. box, you
Yeah,
can
that's
make it go
what
to
I
your
mean.
P.O. box. Yeah,
Okay.
yeah, no, I'm sorry, yes,
Yeah.
and as a property owner, if you want to go to your business address or your accountant or to a P.O. box, you can have your mailing address be something different.
Okay.
But the address on your ID has to match the address of the
Yeah,
property.
that's what I do, I don't send it to my house, I send it to
Yeah, we've got a lot of people that will send it to a PO box, or they'll send it to their accountant, or sometimes elderly people will have their family member get the mail directly. So no, your mailing address does not have to match, but your ID has to match the location. Multiple individuals, married couples on a deed, only one of the married couple need to file the application. If you're a married couple and you got married and one of the property owners had previously owned the property and you since got married, but the new spouse is the one that turns 65 first, you can still file for your over 65. You don't have to get your deed changed. In order to do that, there's a section on the application. You check a box that says married couple. And if there's any reason we question it, we just may ask you for a copy of your marriage certificate to validate that, but you don't have to file a new deed as a married couple to file for an over 65.
So I have a lot of young professionals who each own a property and are getting married, and they each have a homestead
No.
exemption. So when the day they get married, they have to pick one.
They need to pick one.
Okay.
Yeah, married couples can only claim one as their homestead.
And they can do all that online.
They can do that online.
Okay.
Yeah, they just need to let the appraisal district know. One of the things that we see often with couples that are planning estate planning is they will file deeds for estate planning and maybe put the property in the name of a trust. From the appraisal district, we don't know whether that trust is because somebody passed away, because the property transferred, because people don't name their trust in their name. I mean,
Right.
they'll pick some sort of name, but we don't know that is still continuous ownership of the property. So if you are filing a deed for trust purposes, for estate planning purposes, we ask that you let us know, because we see it as a transaction where the property changed hands. We will reset the exemptions. Let us know if it was not truly a transaction, that it was just done for estate planning purposes, and we can go back and reinstate the exemptions. We ask for a copy of the trust documents, and then we're gonna look to make sure that the names match up across the trust documents to the ownership that we have.
So in addition to a trust being able to legally hold a homestead exemption, are there other entities that can or cannot?
Usually it is a trust, and you've gotta be a named beneficiary in a trust in order to claim a homestead exemption. And that is the only exception to it being in the name of an owner.
I have a unique situation with clients who, two women married, divorced. One of them moved, filed her homestead with a new property. My client that's here was appraised in 2021 at like 750. This year, it went up to 1.3 almost million. Did she lose that cap?
It really depends on how they filed the deed, and whether or not we know, because we don't always know that it is a divorce or not a change of ownership. So if she lost the homestead exemption, she would have gotten notice from us.
It's still on there.
Then she did not lose her exemption.
So how did it go up more than 10% on that?
Market value can go up to whatever it's going to go
If
up.
there's no limitation value.
There's no limitation on market value, but the assessed value should not. So what we'll need to do is.
But there's no value limitation reducing that burden, reducing her value.
Then we'll need to look and see if she filed a new application.
Okay.
And we've got a new qualified year on her exemption.
Okay.
Would be what we would need to look at.
Okay, so she just needs to be in touch with somebody.
She just needs to get in touch with our office and let us know that, this is a divorce, I kept the property, it's still my homestead.
Yeah.
I should still get the homestead exemption.
That's
And we just
great.
need to know that. We just, it's just, when we're looking at paper transactions,
Yeah.
we don't know the details
Right.
behind it. So you just need to let us know. And we can reinstate exemptions if they were moved in error.
Okay.
You just need to let us know.
Yeah, I moved my house into a trust, and almost 2 years later, my wife caught it. The exemption fell off, and so we actually reapplied, and we did get a check that caught us back up, so it was
Yeah.
nice, so.
Yeah, just let us know. Again, we just see the transaction. We don't know the story behind it. So it's important just to let us know the story behind it, so that if we need to reinstate the exemption.
What
we
if there
can.
are errors? Do you have a statute of limitations where you can go back a certain time? I'm just curious, does that ever happen?
There is, the appraisal rule can be corrected going back 5 years.
Okay.
So we can go back 5 years and correct the
Okay.
appraisal rule.
Yeah.
So usually most errors like that are caught, people catch that when they get their bill.
Yeah.
To be honest with you, we get a lot of calls and.
But if it's the opposite, where there's a homestead on a home that shouldn't have a homestead, you know what I'm saying? Okay, so
Yeah, we can go back up to 5 years.
Okay.
So on that, the rollback for 2 years, up to 2 years, right? So you buy, kind of your example, you buy the house April 1st, right? It get assessed on the following January 1st, right? They didn't file, we didn't tell them they forgot to file their exemption. So the next year it comes up, that would be the first year of assessment, January 1st of, I guess, 24 now. Do they have the ability, if they caught it now, because it's gone up so much, to go all the way back to that April 1st, or the first when they moved in?
So what they can do is say they find out in 2025, oh, I forgot to file for my exemption. Then what they can do is they can file their application and we can go back 2 years from 2025. So we can go back to 2023 and apply the exemption going back to 2023.
I guess what I'm trying to understand is if the assessment doesn't apply until kind of a year in arrears, all right? If they catch it right after that, can they go all the way back to when they moved into the property? Okay, it just doesn't have the cap benefit, I guess.
So what they can do is if they find out in 2025, oh, I forgot to file my application and I really did qualify January 1st of 2023. They can file their application in January of 2025 or whenever in 2025. We will go back to 2023, apply the exemption. It sets their base year for their cap. They'll get the cap for 2024, that'll get recalculated, their taxes will get recalculated, and they will get a refund based on both the exemption amount and the limitation amount for 2024.
Thank you.
Yeah.
But the opposite can happen with supplemental tax bills, because we deal with that.
Yeah, now, you know, if somebody, you know, somebody has had a house and the person that actually owned it passed away, and then the heirs are selling the property, and we find out that person has been dead for 2 years, we have to, we don't have a choice, we have to go back and remove that exemption going back 2 years, and you can get a supplemental tax bill because that was an erroneously granted exemption. Or if somebody is claiming 2 exemptions on 2 different properties and they shouldn't be, and we find out about it, we've got to go back and take the exemption off of one of those properties, and we go back and take that off, and they can get an updated tax bill or supplemental tax bill because of that.
Difference between what was paid and what should have been paid.
Let's see. You only need to apply for your exemption, your homestead exemption, once, unless there is a new deed filed on the property. And again, if you're establishing the trust as the other owner, or updating the name, or removing the name because of a divorce or deceased spouse, those are things that should not remove your exemption, but you gotta tell us so that we can make sure that we keep them in place or reinstate them if there's a change for those reasons. Again, biggest thing property owners forget to include is their driver's license, and we cannot approve the exemption application until we get the driver's license. And as I said, 57% of property owners forget to include that. So we get a lot of property exemptions that we've got to hold while we try to contact the property owner and get them to submit appropriate documentation. So there can be a real delay in when your homestead gets put onto your property if you forget to include that documentation. For protest, if you want to protest, everybody received a notice of appraised value starting in April, mid-April. If you disagree with the property's market value, then you can protest to the appraisal district. Now again, you're protesting the market value determination. You're not protesting your taxes. You can't protest your taxes at the appraisal district. You can protest the market value of the property. And you can file the protest with the appraisal district. The deadline is May 16th, or if you got a late notice, it's 30 days after the notice of appraised value was mailed out. But for most property owners, it's going to be May 16th is your protest deadline.
Question, when y'all do the appraisals each year, is one of the things you take into an account when you're setting that next year's value, the prior year's value that you set?
No.
That's not a factor?
No.
So if someone, let's say either protesting gets done a little bit or doesn't protest it this year, basically that's just not a factor in determining next year's value?
Nope, our models are redone every year, recalibrated every year. The only thing that we take from last year is the assessed value. Last year's assessed value plus 10%. Your limitation value is the only one that carries over.
Okay, so for people that have values that are now 200,000 plus higher, if they come in and protest their taxes, unless if they have a homestead exemption already in place, you get that, you're not getting that down to where that is. There's almost no point in really.
So the question for property owners is how will a protest affect my taxes?
Right.
Okay, and you're protesting market value at the appraisal district, and you've got a market value of 600,000. you have an assessed value of 338, because that's our median assessed value.
Yeah.
You may get this 600,000 down,
Yeah.
but you're not getting below this 338.
That's exactly what.
It's not going to impact your taxes unless you get below this assessed
Oh,
value.
wow.
That's
So you
what-
better be able to show that the house is a hellhole.
If you're not getting below that assessed value,
We're done
then
here.
your taxable value is not being adjusted at all.
But if you ever remove that exemption and you turn that property into a rental or an investment property down the road,
Wow.
then your value's gonna immediately skyrocket over the top, because you don't have that exemption.
So if it has the exemption right now, it's gonna have the exemption for the remainder of the year.
Yeah.
So protesting now to get this market value down because you don't plan on filing the exemption next year, again, it's not going to affect your taxes this year, and this market value this year goes away when we're calculating market values next year. Because again, January 1st is a fresh start for us, and we recalibrate our models every January 1st.
So, for properties, the only one that makes sense to protest the property value would be an investment property, a rental property, something like that, if it has exemption.
Or a new buyer.
Or, yeah.
Who doesn't have
For a new
a
buyer.
cap yet.
Yeah.
Who doesn't have a cap.
Yeah, unfortunately, rental properties, investment properties, they don't get the benefit of that homestead limitation. So anything that you get reduced here is going to affect your taxable value.
Or if you, like you just said, if you have a new buyer and for some reason that came in higher than what they
Yeah.
paid, then that would make sense.
Yes, yeah. But for most property owners, that gap now between what your market value is and your assessed value is so great
Yeah.
that I just, I don't think there will be many people that will be able to make the case
Yeah.
to get their values reduced enough to go below their assessed value.
I have one more question, I just wanna make sure, so we've got the exemption, which we can do at any time, whether regardless of January 1st, and then the limitation is the cap of the 10%
Yeah.
plus whatever the assessed value is. So when people are talking about their homestead exemption, we're actually talking two different terms.
Two different benefits.
Right, two different.
Yeah, you get an exemption and it gives you two really different benefits
Yeah.
on it.
Thank you.
I have a question just to clarify that.
Yeah.
Last week I was in a workshop with a tax protest company,
Mhm.
and part of their whole, point that they were trying to make is that it's so important. There's obviously, they've got an ulterior motive, but they say it's so important that you protest every single year, because you're constantly pushing down that foundational value. And so that 10% can only go up. So over the course of 5 years, you wanna keep that property value as low as possible, because it will ultimately limit, when you do 10% 1 year over another, if you've got that value as low as possible, it will potentially save a homeowner money. And I'm hearing you say something different than they're saying, and I'm trying to understand what the truth
I think
is.
it's a conundrum, because half the time I'm doing CMAs to get my buyers as high as possible on their appraisals and fighting for that so that they don't have to bring so much to the table. And I feel like as realtors, we're fighting both. We want it to come down and we want it to come up.
But I mean, I think there's a difference, and it's black and white, because you're the appraisal district and these people are fighting it, and so there's a real truth around that. So it seems to me, my understanding until I walked in here was that you do want to, no offense to you.
No,
because I know
no.
you work for the county, but I mean, as a homeowner, right, you don't wanna pay more than.
So, filters off.
Yeah.
Here's the truth for you, okay? So when appraised values don't go up very much on a year-to-year basis, say we only go up 5% or 6%, in that case, there's a case because the assessed value is last year's assessed value plus 10% or the current market value, whichever is lower. So if last year's assessed value is 10% plus, but the current market value only went up 4%, then there's a chance the current market value might actually be lower. And in which case, it may benefit you to file the protest because that gap between the market value and the assessed value is really small. And so that might be a benefit. Last 2 or 3 years, our values went up 24% last year, 53% this year. Your gap now is like this, and this is going up like this. So it doesn't really benefit you to protest every year when you've got this much of a gap.
And every year you're setting a new market value,
Every
so
year.
even if you
Right.
It's just resetting the clock.
If our market continues like it is, I mean, then, the chances are we'll probably have another double-digit increase next year. And that gap just gets bigger because, again, you can only go 10%. It's gonna take you a long time to catch up with this. So that's the unfiltered truth of
Thank
there's
you,
truth
because
on
that
both
wasn't
sides.
really
Yeah.
making sense to me, and now it does. So thanks.
So I'm gonna ask you a question actually before the thing
Yeah.
started, which was, okay, so we have gone our entire lives looking at the difference between the assessed value and what we find as market value to be, not assessed, I'm sorry, let me start over. Your market value versus our market value was never on the same page, right? All of a sudden it is. I mean, my personal property taxes, when I looked at what y'all's market value was, I was like, yep, that's pretty much it. Why? I mean, I know why. I know why that you had to do it because y'all were being audited or whatever you said. What changed?
We have different sources of data that we're able to utilize, and we have different models that we are able to implement. We've got new software that we're able to integrate the data that we do have, and the comptroller gives us a 5% margin of error. In the past, we may not have targeted to be 100%. We may have targeted to be 98, 97, because we knew that we had that margin. Well, we failed the last 2 years. We have to target to be at 100%. So we're driving it to be at 100% more now than we have maybe in the past. So those are some of the factors that are why you're seeing such a difference.
So this new data, is it the MLS data?
Nope.
Okay.
That was
Nope.
one of my questions.
Nope, and I will tell you guys this, even when we're denied MLS data, the comptroller still uses MLS data to test us.
I know, yeah.
So I failed because I didn't have the data.
Right.
I still get tested, and there still is a requirement and expectation that I'm going to find the data from somewhere. So we gather all the data that we
Where do
can.
you get the sold data?
We are getting it now off a state contract from the state of Texas.
What does that mean?
The state has a DIR, the Department of Information Resources, and they've got a vendor that they have. Nope, not CoreLogic.
Very in trouble with that.
Nope, not CoreLogic.
You know what's gonna be a problem though?
Actually,
Yeah, sorry.
Oh, sorry. You should have held my question to the end.
So, filing a protest, again, the fastest and easiest way to file your protest is to do it online. You can get immediate confirmation that your protest has been filed and accepted. You can upload any evidence that you want the appraisal district to review to the website. We can accept and we'll send you an offer. If you upload evidence you want us to review, we'll send you an offer. You can accept or reject that offer online. Or you can file it in person, or you can do it by mail. But again, the fastest and easiest way to do it is to do it online through our online portal. We will set informal meetings. Again, anybody that e-files will automatically get an offer, but that doesn't mean that you won't get an opportunity to meet with an appraiser. We've got a process where you can get in line online. It's on our website, and you can go in and you can schedule yourself for a meeting with an appraiser for an informal, or you can get in line for a same-day meeting. Now, I will say this, it's better to get in line and schedule your appointment for a future date, because if you get in line for same day, we've got a lot of people that are in line for same day, and you've got a little bit of a wait. Whereas if you get in line for a scheduled appointment, you get priority over people that are in the same day line. So you can get in line online.
How do you feel the process works with somebody who hires a third party during this process? Does it go smoother? How do you guys feel about someone else?
You know,
Professional doing it as an individual?
You get a lot of the third party consultants will advertise that they get more or less of a reduction than if a property owner were to do it themselves. It really is about what does a property owner have time to do? Do you have the time to devote to do the research? Do you have access to the resources to do the research? We think that property owners and agents get the exact same amount of reduction. So it doesn't matter whether you do it yourself or you hire an agent to do it. We're going to evaluate the evidence the same way and, based on the evidence, give you whatever reduction is warranted. So if you're a property owner or you can provide your property owners the information, they can do it themselves and just submit the information themselves. But if they don't have time or they don't want to take the time off work to have to do the meetings or go to a formal hearing, then a consultant may be convenient for them. We are doing our informals, again, we're doing them virtually, so we make it really convenient. You get to schedule, you get to pick your own date if you get in line, and we do our ARB formal hearings virtually as well, so you don't have to come and sit in our waiting room for 2 hours to get into in a panel room. We'll call you when they're ready, and then you can just pop in at your convenience. So we think we've made the online opportunities a lot more convenient for property owners to take advantage of them. If you don't resolve your formal, your informal, your hearing is not resolved informally when you meet with an appraiser, then you still have the ability to go to the Appraisal Review Board, and that is with an independent body. The Appraisal Review Board is set and appointed by the local administrative judge. They sit in panels of 3. They're not CAD employees. We have no oversight over the ARB. They have a chairman that runs their operations, but the ARB, their job is to listen to the evidence from the appraisal district and from the property owner and come to a value determination. So if you don't settle informally, you do have the opportunity to go to a formal hearing with the Appraisal Review Board. Evidence that can help a property owner lower their market value. Again, sales price and sales information, market data. There may be some information that we don't have, so that's always helpful. Correction of property characteristics. We had talked earlier about if it's 1 story, 2 stories high, could be a characteristic that might need to be corrected. If you've got foundation issues, if we can't see the cracks inside your house, some evidence of that kind of damage, cost to repair estimates are always helpful. And if you've had any recent fee appraisals done, that's always good information to bring into the appraisal district. So to prepare your clients, just don't be surprised. These are just a few examples that we see. Jack and Jill have owned their home for 30 years, and Jack is a disabled veteran. Both Jack and Jill are over 65, and they pay $2,000 a year in property taxes. In 2020, Jack and Jill sold their home to John and Jane, and John and Jane are young first-time homeowners. In 2020, they paid $1,500 of their prorated tax bill that they bought from Jack and Jill, but in 2021, they were shocked to learn that their property tax bill is now $8,000. And that's because they don't get the over 65 exemption, they don't get the tax ceiling, a lot of that goes away. So we don't want them to be surprised as new homeowners that their tax bill is going to change, particularly based on the exemptions from the previous owner. They are often surprised when they get their first full year tax bill, and you don't research the history behind it. Know if it's an over 65 property owner, be aware if they're going to transfer that exemption. And then also be aware that if we have an over 65 and the person has been deceased, that exemption may go away, and that may increase their tax liability as well.
And on your website anymore, it doesn't say over 65 anymore, right? It just says other?
Yeah, we are legally prohibited from putting
I agree with that,
indication.
but
Yeah, it will say other, and other could include not only over 65, but it could be disabled or some other exemption. So it's an indication that there's something more than just a homestead, but we can't say what it is.
Okay.
Yes?
For the new buyer, that the assessment comes out and it's gonna go to the old owner, right? So for the new person, for the, whatever the PIN number or something that's supposed to be on there, how are they to get that if we're not able to get it from the previous owner?
Okay, so the notice has gone out. It went to the owner of record that we had on our files as of January 1st, but now the property has changed. You're a new owner and you want the PIN number. It can take, because we get our deed information from the county clerk on a monthly basis, so it can take 4 weeks for us to get it from the clerk's office, and then take us another 3 to 4 weeks to process it on our side. So there can be a 6 to 8 week time frame between when the property is sold and when we get an update of the new ownership. Once we get our records updated and reflected, then you as the new owner can step into the shoes of a previous owner. If they had already filed a protest, you get to step into the shoes of the protest that they've already filed, but you can also make a request to get a copy of the PIN number. Now you can't file a protest because the deadline is the deadline. So May 16th was the deadline, but if the previous owner had already filed a protest, you can step in their shoes as the new owner and you can contact our office to get a PIN number.
I don't wanna belabor that point there, but if I bought a property, or someone did, and they are gonna, and there's no way the previous owner is gonna protest that tax value, I can get the PIN number, but if you guys don't have the record of the new ownership, I can't do anything about it.
We cannot,
Despite property damage or.
we cannot just provide PIN numbers to anybody that calls and asks us for it.
Yeah.
We want to make sure that we're providing it to somebody that is qualified.
As long as it's updated before May 16th.
May 16th, May 16th
And
is
is
our
there any
deadline.
way, Okay, but if it's not by May 16th, then there's just no opportunity to protest that.
There's not gonna be an opportunity to protest before that deadline.
Alright, that's if we cannot get in contact with the previous owner.
Mhm.
Can that previous owner just give the person the PIN number and do that way, or is it, how does that work?
I would say if it is a case of a new property owner, rather than trying to get a PIN number and get somebody else's PIN number and utilize that in an inappropriate way, I would say file your protest on paper.
Okay,
File it by paper,
Yeah.
and then you get it in time.
okay,
Um,
yeah.
And that way you don't have to worry about getting the PIN number, you just submit it by paper. I don't want anybody to do anything illegal.
I didn't know that was illegal.
Yeah.
Like Netflix.
I was gonna say,
Yeah.
you're sharing the password.
So, say I have a client who's been in a house for 10 years, and they refi, and the refi comes with an appraisal.
Mhm.
Does their
Does that matter to you?
set amount stay this, like their capped 10% amount?
The cap is just a calculation based on last year's limitation value plus 10%. If they come in with a refi appraisal, then that may lower their market value. If they bring in
Okay.
the appraisal, that may affect.
But whatever
market
that
value.
new appraisal is their new number?
If they come in and they bring in evidence that the market value should be adjusted, we will adjust the market value. But again, that does not change that calculation for the limitation.
Okay, that's my question.
Yeah, it does not change the calculation for the limitation. And please be aware that, our assessment date's January 1st. So we are time adjusting sales to match what they would have sold for on January 1st.
Someone from Facebook asked. Facebook. I'm multitasking here. If they add a casita, does their homestead still apply and limit our tax burden to 10% per year, or do you reset that? So I guess major improvement. You do a
So-
major improvement to the property.
So what happens when you do an improvement to the property? Your homestead limitation is a little more complicated calculation than just the last year's plus 10%. It's last year plus 10% plus any new value. But we don't see people adding new value very often, so we don't talk about that.
You're talking about no permit.
But if they add a granny flat on their property, then that could impact two ways. It could impact, it depends on what they use that property for, what they're using the granny flat for. If it is just an extension of their homestead and it's being used by their family, then it can remain as part of their homestead. Their cap will get adjusted based on the new value for that granny flat. But if they're using it as a rental flat and it's not being used as their homestead, then the granny flat is not included in their homestead. And therefore they get taxed on the full amount of the granny flat as a separate line item, and then the limitation applies only to their homestead.
Wow. Is there a difference if it's a freestanding granny flat or one that's attached like to the main,
Like a
like a covered walk?
It doesn't matter.
Okay,
If
it's the use.
it's new bricks and sticks, then it adds new value to the property. And it doesn't matter if it's detached or attached. Your property taxes can only increase 10% per year. And again, taxes are based on the tax rates, and if your voter approval tax rate is a 15% increase, then your taxes will go up because of the voter approval rate. The limitation is on that homestead limitation. That's the only one that can go up 10% per year, but everything else has different limitations. Again, in general terms, cities and counties can only go up on levy 3.5%, but if they do a voter approval and voters approve it, it can be whatever voters approve it. So there's no hard limit on that. Because Texas is non-disclosure, it's illegal for appraisal districts to know how much a property is sold for. And being non-disclosure just means I don't get the data automatically. I've got to pay for it and go through a lot of hoops to get it. But the expectation with the state is that I will get it because they test me against it. So there really is an expectation that we will get market data and do our appraisals based on market data.
Can I ask a quick question about them testing you? Because you said the comptroller does have access to the information, and they expect you to have the information, but everybody makes it really hard for everyone to have the information. I mean, does that sum it up? The comptroller knows what you're supposed to know,
The
It
comptroller
won't let
has,
you know it.
I'll
so
test you for it.
I'm required to provide to the comptroller all of my market data.
Uh-huh.
They get everything that I have,
Sure,
and then they supplement that with
Uh-huh.
additional information
right,
that I don't have.
okay.
So I get tested against everything that they get from me and what they are able to collect themselves.
So they do share information.
They do not share their information with me. I have to give them my information.
Oh.
They don't give me their information.
And they have access to our MLS data.
I don't know if they have access to your MLS data, but they have access to data,
Today.
that additional data that I don't have. And I would say that you should ask the comptroller what their sources of data are, because I don't want to speak for them.
Sure.
So it seems like the whole non-disclosure discussion is kind of worthless, because you're gonna get the data somehow, you're expected to have the real data, like, I mean, not say our clients need to go, sharing the data, but we're not hiding anything, they're gonna know the market values, and we certainly found that out this year.
Yeah,
Yeah.
I mean, again, the expectation.
Yeah, it is what it is, yeah.
Is that I will appraise at market value.
Mhm.
And expectation is I will figure out a way to get it.
Yep, all right.
The appraisal district raises the values, just to keep the taxing units so they can keep their taxing rate the same. And so it's the appraisal district that increased my taxes. And again, this is something that is, really misunderstood in the tax rate setting side, and that comes in August and September. But there's a reset, there's a hard reset that happens when we certify the values, and it's called the no new revenue rate. And they calculate that no new revenue rate, which is the rate that we get them the exact same amount of levy this year as they got last year. It's a hard reset. So comparing last year's tax rate to what they adopt this year is kind of like taking a shower and putting on dirty underwear. Using that comparison to last year's rate. I mean, that really, you don't listen to a comparison to last year's rate. The comparison should be based on what is the no new revenue rate, and did you adopt a rate higher than the no new revenue rate? If you did, they're required by law in their adoption to say, we're adopting a rate higher than the no new revenue rate, and this is increasing taxes. But we still hear a lot of comparisons to last year's tax rate. And again, that's really not a fair comparison. The comparison should be with the no new revenue rate. And one last thing. Oh, May 7th. The election on May 7th. There's an election that would increase the homestead exemption. It would go up for school districts from $25,000 up to $40,000. And then there is also a provision for over 65 property owners when they did House Bill 3 and a lot of the refinancing and Senate Bill 2. They compressed school district rates, but because over 65 property owners have already had tax ceilings, they never saw the benefit of that rate compression. So what Proposition 1 would do is it would allow them to feel some of the benefit and get their tax ceilings reduced because of the rate compression. And those are the two propositions that are coming up in the May 7th election. And again, we encourage property owners, if you need to know more information about where to go, where's your polling place, votetravis.com is a great place to go.
And I think early voting's already started?
Early voting's already started, yeah. And then starting in August, travistaxes.com, property owners can go out, and we put on that website, you'll get what your current value is, your taxable value, what each entity is proposing as a tax rate, what their no new revenue rate is, what the difference in taxes between those are, and where are the budget meetings and the tax rate setting hearings are going to be. And those are published. You get the date and the location, and that's all on the Travis Taxes website, so that you can participate in that side of the equation as well. Because again, if they're voting for a tax rate that is 8% increase, that's going to affect how much you pay in taxes. If they go above the no new revenue rate, it's more taxes that you have to pay. So you need to go out there and participate in that side of the equation. And I always like to make the analogy, it's a me, you, we. You know, if somebody else is paying for the wedding reception, then I think everybody should drink champagne. If I'm paying for the wedding reception, we're all drinking water, and I may just be pulling the hose from the backyard. But maybe we can agree for the services that we want that iced tea is a good compromise. And so I'm not saying that we should say we don't ever want tax increases, because sometimes we want additional services and we've got to pay for those services. But we've got to participate in that side and let our taxing entities know what services do we want and what services do we think we can do without. so that they can lower those budgets and lower our tax burden.
Awesome.
And that is
So
everything.
if we're collecting, let's just say 30% more revenue,
Mhm.
or all the revenue, the taxing entities have all this much more money. They go back in hearings and go, well, we have a surplus. They could in theory lower their tax rates, or is that, maybe I'm being,
Yeah,
more dreamy on this.
Their starting point every year should be the no new revenue rate, which is what's the rate need to be to get you the exact same amount of money as last year. Now, they can set their budgets that are smaller than last year's budget and lower the rate even more and adopt below the no new revenue rate. But if we're just talking about an even playing field of, I'm gonna keep my budget the same, we're not gonna do anything new, no new revenue rate will get them the exact same amount of money as they got in the previous year.
They raised it last year.
Seems
So-
kind of dreamy.
So any tax rate that's adopted above the no new revenue rate is an increase in taxes.
Okay.
Now, there's a lot of chatter and you'll hear a lot, and I have to defer to the experts in school finance.
Yeah.
Cause there's a lot of discussion about Austin ISD and recapture dollars, and, it may behoove you guys to have somebody come out and talk about school finance and what that means. But I know that, school taxes are 54% of your overall tax bill, and if 50% of that is going to recapture,
Yeah.
then that means 25% of your overall tax bill is going to recapture. And that's a significant impact for our tax dollars.
So first, thank you, and thank you guys, because I can't imagine that you're not very busy right now, so.
Yeah.
Yeah.
Thank you very much.
Do you have one piece of advice for us as agents out there talking to the public? I mean, we're also, many of us are homeowners as well, but is there anything in particular that, because, I mean, sadly, they do blame the appraisal district as the boogeyman and all of that stuff. So, clearly you are not a monster. So what would be the best thing for us to that we can tell our SLI people?
I would tell them that, again, appraisals are just one part of the equation. And we get a lot of people that will come and protest their appraisals. And we're happy to talk about your market value, but you can't protest your taxes to the appraisal district. You've got to go talk to your taxing entities. Now, on the website, travistaxes.com, they can give feedback to the taxing entities from that website. So there's a feedback button that if you want to tell the city council exactly what you want and what you don't want, you can provide them feedback there. But it's really also very meaningful when they see bodies in the audience and people are giving them feedback at the budget hearings and the tax rate hearings. And again, to be kind to them, they're trying to provide services we demand, so we also have to be willing to say, what services are we willing to give up? But really, that tax rate side is a really huge part of the equation that people just miss. Yes.
You said when you're protesting market value, your values are based on what your property's worth January 1st. So when protesting, is there a range of time in which I would show you like things in my neighborhood that didn't go for as high as I was assessed for, or?
So our date range that we look at is we go back to the previous January 1st up until February 28th is the date range that we look.
A year.
We look for a whole year back.
Okay.
Yeah. Now, please be aware, again, because the market is appreciating so much, there will be a time adjustment on the sales. But we do
January
look,
1st through January 20th.
so for 2022, our time frame would be January 1st of 2021 through February 28th of 2022. And that's the date range that we gather data from and incorporate into our models. And then we take the month of March to kind of crank the models out and send our notices in April. So we have to kind of cut off in February. Now, that's not to say that you can't bring additional data in that happened after that date. If you felt that it made your case, you could bring additional data in. But that's the time frame that the appraisal district uses.
Okay. Well, thank you very much.
Yeah,
Really appreciate it.
Thank you.